There's a moment in every debt crisis when the numbers stop making sense, when the interest payments exceed the tax revenue, when new loans are needed just to service old ones, when the entire system runs on borrowed time and borrowed money. And the strangest part, everyone knows it's unsustainable. The economists know, the politicians know, the markets know, but the machine keeps running anyway because stopping means admitting the truth. The debt can never be repaid. It can only grow until the weight of it collapses everything beneath it. This is not a modern problem. This is the oldest trap in economic history. Empires, kingdoms, republics, democracies, it doesn't matter. Once a government discovers it can borrow its way out of hard choices, it never stops. The first loan seems reasonable. Infrastructure, defense, public welfare, all legitimate uses. But then comes the second loan, and the third. And soon the borrowing is not for investment, but for survival. To pay the interest on previous debts, to avoid default, to maintain the illusion of solvency. And by the time anyone realizes the trap is closed, it's too late. The spiral has already begun. What makes the debt spiral so insidious is that it feels sustainable for decades. Interest rates stay low. Lenders stay confident. The economy grows just fast enough to keep the ratios manageable. Politicians can keep promising more services, lower taxes, higher spending, all at the same time. It looks like magic, but it's not magic. It's leverage. And leverage works beautifully until the day it doesn't. Let's begin with the Spanish Empire in the 16th century. Spain controlled the richest empire the world had ever seen. Silver poured in from the mines of Potosi in South America. Gold flowed from Peru and Mexico. Spanish crown was drowning in wealth, and yet Spain declared bankruptcy 4 times between 1557 and 1647. How does the wealthiest empire in the world go bankrupt? It's by spending more than it earns, even when it earns more than anyone else. Spain's problem was war. Constant, expensive, unending war. Against France, against England, against the Dutch rebels, against the Ottoman Empire. Every conflict required soldiers, ships, weapons, supplies, and Spain paid for it all with debt. The crown borrowed from Italian and German bankers at ruinous interest rates, sometimes as high as 20 or 30%. The silver from the Americas was pledged years in advance to pay off previous loans. And when the silver arrived, it went straight to creditors, not to the Spanish treasury. This created a perverse dynamic. The more wealth Spain extracted from its colonies, the poorer the crown became, because the wealth was already spoken for. It was collateral for debts that could never be fully repaid. The Spanish government was trapped in a debt spiral. It had to keep borrowing to service existing debts, and every new loan made the next crisis worse. By the mid-17th century, Spain was still technically wealthy, but functionally bankrupt. The empire had become a machine for transferring wealth from the New World to European bankers. The lesson from Spain is clear. Resource wealth does not protect you from debt spirals. In fact, it can make the trap worse because it creates the illusion that you can always borrow more. Lenders believe you have collateral. Politicians believe you have revenue. And everyone ignores the fundamental math. If your debt grows faster than your income, eventually the interest payments consume everything. Move forward to revolutionary France, and we see the same pattern with a different ending. By the late 1780s, the French crown was drowning in debt. Decades of war, particularly the expensive intervention in the American Revolution, had left the treasury empty. The government was spending twice what it collected in taxes. And half of all tax revenue went just to service the debt, not to build roads or fund the military or feed the poor, just to pay interest to bondholders. King Louis XVI knew the situation was unsustainable. Tried to raise taxes on the nobility. They refused. Tried to cut spending. The bureaucracy resisted. He tried to borrow more. The lenders demanded reforms first. Every option was politically impossible, and so the debt spiral continued until it didn't. In 1789, the entire system collapsed, not gradually, not predictably, but in a sudden, violent rupture that devoured the monarchy, the aristocracy, and eventually the revolution itself. What destroyed France was not the debt alone. It was the impossibility of escaping the debt without political transformation. The old regime had structured itself so that those with wealth and power paid almost nothing in taxes, while the peasants and urban poor carried the entire burden. This was politically stable as long as the debt was manageable, but once the debt became unpayable, the only solution was to tax the rich, and the rich would rather burn the country down than pay, so they did. The French Revolution was, in many ways, a debt crisis that exploded into political chaos. The lesson here is darker. Debt spirals are not just economic, they are political. They expose every structural inequality, every embedded privilege, every lie that holds a society together. And when the spiral reaches its end, the reckoning is not just financial, it is total. Now let's cross the Atlantic to Latin America in the 1980s. After the oil shocks of the 1970s, global banks were flush with petrodollars and desperate to lend. Latin American governments were eager to borrow. The money flowed in torrents. Brazil, Argentina, Mexico, Chile all borrowed billions to finance infrastructure, industrialization, and in many cases, corruption. The loans were denominated in US dollars, which seemed safe at the time because the dollar was stable and interest rates were low. But then in 1979, the US Federal Reserve, under Chairman Paul Volcker, raised interest rates dramatically to fight inflation. Suddenly, the cost of servicing dollar-denominated debt exploded. Latin American governments had borrowed at 5 5 or 6% interest. Now they were paying 15 or 20%. And because their revenues were in local currencies that were depreciating against the dollar, the real burden of the debt doubled or tripled almost overnight. Mexico was the first to crack. In August 1982, the finance minister announced that the country could no longer service its debt. Default was imminent. The news sent shockwaves through global markets. Mexico could default, so could Brazil, Argentina, Chile, and dozens of other developing nations. The entire international banking system was at risk. Banks that had lent billions to Latin America suddenly faced catastrophic losses. What followed was a decade of economic devastation across the region. The 1980s became known as the lost decade. Growth stalled. Unemployment soared. Governments imposed brutal austerity measures under pressure from the International Monetary Fund. Public services were slashed. Wages collapsed. Entire generations saw their futures evaporate. Through it all, the debt continued to grow because the countries could not generate enough revenue to pay it down. They could only roll it over, borrowing new money to pay old debts. The Latin American debt crisis revealed something essential. When you borrow in someone else's currency, you are not in control of your destiny. You are a hostage to exchange rates, to foreign interest rates, to the decisions of central banks thousands of miles away. The debt spiral in Latin America was not caused by irresponsible spending alone. It was caused by a structural trap. Borrow in dollars, earn in pesos, and pray that nothing changes. When everything changed, the trap closed. But sovereign debt spirals are not confined to empires or developing nations. Advanced economies face the same trap. They just disguise it better. Consider Japan. In 1990, Japan was the rising economic superpower. The stock market was the largest in the world. Its companies dominated electronics, automobiles, and manufacturing. Analysts predicted Japan would overtake the United States as the world's largest economy within a decade. And then the bubble burst. Japanese stock and real estate prices collapsed. Banks, which had lent aggressively during the boom, were suddenly insolvent. The government responded with massive stimulus spending, borrowing heavily to prop up the economy. At first, the debt seemed manageable, but the economy never fully recovered. Growth stalled, deflation set in, tax revenues fell, and the government kept borrowing to cover the gap. Today, Japan's government debt exceeds 250% of GDP, the highest in the developed world. And yet, Japan has not collapsed. Interest rates remain near zero. Investors still buy Japanese government bonds. The country functions, albeit slowly. So does this mean the debt spiral is a myth, that governments can borrow forever without consequences? Not exactly. Japan's survival depends on a unique set of circumstances. Most of its debt is held domestically, not by foreign creditors. The Bank of Japan owns nearly half of all government bonds, effectively monetizing the debt. Japanese citizens have high savings rates, providing a steady source of demand for bonds. And Japan runs a trade surplus, meaning it earns foreign currency and is not dependent on external financing. These factors give Japan room to maneuver that other countries do not have. But even Japan is trapped. Government cannot afford to let interest rates rise because the debt service costs would explode. Cannot cut spending significantly because the economy is too weak. And it cannot inflate away the debt without destroying the savings of its aging population. Japan is stuck in a permanent state of low growth, low inflation, and high debt. It has not collapsed. But it has not escaped either. It simply exists in a kind of economic purgatory, sustained by central bank intervention and the patience of its creditors. The Japanese example teaches us that debt spirals do not always end in dramatic collapse. Sometimes they end in stagnation, in slow decay, the quiet erosion of prosperity across generations. The crisis is not sudden, it is permanent. And now we arrive at the present. United States, the European Union, China, nearly every major economy on the planet is deeper in debt than at any point in peacetime history. The COVID pandemic added trillions to government balance sheets. Interest rates, after years near zero, have finally begun to rise, and the arithmetic of the debt spiral is becoming impossible to ignore. In the United States, the national debt now exceeds $38 trillion. Annual interest payments have surpassed $1 trillion more than the country spends on defense. If interest rates remain elevated, debt service will soon be the largest line item in the federal budget, crowding out everything else. Social Security, Medicare, infrastructure, education, all of it will compete for a shrinking pool of resources. And the only way to avoid cuts is to borrow more, which makes the spiral worse. Europe faces a similar trap, compounded by political fragmentation. Countries like Italy and Greece have debt-to-GDP ratios well above 100%. They cannot print their own currency because they use the euro, and they cannot rely indefinitely on the European Central Bank to buy their bonds because Germany and other northern countries oppose unlimited monetary financing. Europe is trapped between fiscal discipline, which would trigger recessions, and monetary expansion, which would inflate away the savings of its citizens. China's situation is different, but no less dangerous. After decades of debt-fueled growth, China's total debt, including government, corporate, and household debt, exceeds 300% of GDP. Much of this debt financed infrastructure projects that generate little economic return: ghost cities, underutilized high-speed rail, massive industrial overcapacity. The debt was useful for maintaining growth and employment in the short term, but it has created a long-term trap. The debts must be serviced, and servicing them requires more borrowing. China is experiencing its own version of Japan's lost decade, just faster and at a much larger scale. The global debt spiral is not a future threat, it is the present reality. Every major economy is trapped in the same logic: borrow to avoid pain today, defer the reckoning to tomorrow. But tomorrow keeps arriving, and each time it does, the only solution is to borrow more. Here's the brutal truth: there is no escape from a debt spiral once it begins. You can inflate it away, but that destroys savings and wages. You can default, but that triggers financial collapse and locks you out of credit markets for years. You can impose austerity, but that causes recessions and political upheaval. Or you can keep borrowing and hope the system holds together long enough for growth to eventually outpace the debt. But that last option only works if growth actually materializes. And in aging, over-leveraged economies, growth is becoming harder to generate. This is the trap. Every solution creates new problems. Inflation punishes savers, default punishes creditors, austerity punishes the poor, and more borrowing just delays the inevitable. The debt spiral has no good ending. It only has different kinds of bad endings. And the longer it continues, the worse those endings become. So what does this mean for you? It means that the financial system you live in is built on unsustainable debt. The promises your government has made on pensions, healthcare, infrastructure cannot be kept without borrowing that will eventually break the system. The assets you hold, stocks, bonds, real estate, are priced on the assumption that this debt spiral will continue smoothly. But history says it won't. The survivors of debt spirals are not the ones holding government promises. They are the ones holding real assets that retain value when paper collapses: land, productive businesses, commodities, skills that cannot be inflated away. The debt spiral consumes paper wealth. It always has. It always will. The question is not whether the spiral will end. It will. The question is what you will be holding when it does.